Perfect. Good evening, everyone, and thank you so much for joining us today. My name is Akshay Iyer. I am part of the advisory team here at Sarwa. I'm really excited about this one today because we're going to be continuing our Sarwa Talk series with one of our favorite personal finance authors, Andrew Hallam. Andrew is the best-selling author of Millionaire Expat, Millionaire Teacher, and his latest book, Balance. Sarwa have done quite a few sessions with Andrew in the past because honestly, out of all the investment gurus out there, we really find that he is somebody who's able to simplify concepts really well, whilst also being backed by data. But most importantly, he's somebody who's been invested for over half of his life. And this experience, honestly, of all different types of markets definitely speaks volumes of truth, especially during the year that we've had. So thank you, Andrew, for joining us today. I know it's bright and early in Panama this morning, so really appreciate your time.
And it's not too early. It's bright, but it's not too early. So I'm really happy. We're happy to be here. Thanks for the invite.
No, of course. It's always a pleasure to have you. And Sarwa and Andrew, we have started this tradition. We were just talking about it a second ago. It seems that we're doing this year-end summary for the past few years, and this is going to be our third edition of it. It's been a very interesting year, and I think especially for anyone who's been invested. And today we're going to be going over some of the key themes, some of the major events that have happened during 2022, how they've impacted markets. But most importantly, we're actually going to be looking at strategies to take us into 2023 and this to the future in general. So just a heads up for everyone, we're going to be doing a pretty short presentation, but we really want this session to be interactive. So please ask any questions that you have in the Zoom Q&A, and we're going to make sure to address those as well. So before we get started, the usual disclaimers. So firstly, we don't have a crystal ball and cannot predict the future. Unfortunately, I can't, Andrew can't, famous investment gurus such as Warren Buffett can't. Unfortunately, no one can actually predict exactly what's going to happen in the future. So if you were here to, hopefully get some stock picks, I don't think we're going to be able to provide those today. Also, the discussion today should not be interpreted as one-on-one financial advice. But with that being said, it usually does account for a lot of people. So if you have any particular questions about your individual circumstances, please let us know in the Q&A or reach out to the Sarwa team directly. Okay, so we're going to be covering these key themes today in terms of topics for 2022. So another heads up, today's session is going to be all about the stock market. We're mindful that a lot happened in the crypto space too, but we definitely need a lot longer than just this hour to cover that as well. And look, I'm sure a lot of you have been following the news. These topics have definitely come up. And we want to dive a little bit deeper into each of them to provide some context on what this roller coaster of a year has been. But even just going into that exactly, Andrew, I wanted to ask, what is your summary of 2022? How is this compared to our last few years?
Well, generally, what people get really used to is when markets continue to rise, they get used to that. And they think markets will rise every year. And we really have had almost actually like an uninterrupted annual calendar year rise from 2009 right up until 2021. I know we had that blip in 2020, but the year still ended up with a significant gain. So I think there was only one year that was a calendar year drop between 2009 and 2021, and that was a really small drop of about 4%. We get used to market drop. Or we get used to markets rising. People get really kind of complacent and figure, oh, this is just what happens. Markets average double-digit gains every year, but they don't. Long term, we get market drops about 1 out of every 3 years on average. And sometimes those market drops could be 2 or 3 years in a row. And then other times, as we've had, you'll get a period of about 7 or 8 years where there isn't a market drop, or a significant one might just drop a smudge. So this year we got the first, what I'll call the first real market drop since 2009. It'll be a calendar year decline for sure. And this is actually a really good thing. It's a wonderful thing on loads of different levels, because as investors, you are collectors. You are accumulating assets. And a market drop is much like a supermarket sale. It's not bad news. And people, interestingly, when they go into a supermarket, don't freak out and say, oh my gosh, bananas are on special this week. I'm really afraid bananas are cheap. If you're a regular purchaser of bananas, you actually want the price to drop. You actually want discounts. And we have to think of the stock market exactly the same way. So Akshay, honestly, 2022, it's on so many levels in terms of investment levels, in terms of how investors should think. Fabulous year, fabulous year.
Exactly. And Andrew, I think I've said this to you before, but the reason why you're definitely a millionaire is because you've just used that example of bananas. When we speak to clients, we normally say that expensive watch that you want to buy, when that's on discount, to maybe not think about it the same way as your investments. So I love the bananas example. I love the bananas example. Okay. So look, as you said, 2022 has been an extremely rocky year. I just want to go into it a little bit further, just to provide some context in terms of markets. So we entered a bear market. We entered bear market territory in general. When we look at markets, we see the S&P 500 index. This is an index that tracks the 500 largest companies in the US. It's almost down 20% to date. The S&P 500, the reason why we have it up here is because a lot of investors set this as a benchmark. It's usually compared to a lot of other general investments. If we look at this chart in the middle, this is Vanguard's total world stock fund, and it's down around 20% this year. This ETF tracks companies across a variety of different variety of different assets, sectors, geographies. It's a good representation of the overall global stock market. And the chart all the way on the right, this is Vanguard's total world bond ETF. This tracks global bond markets, government bonds, corporate bonds, and this is down around 11% year to date. The combination of the two Vanguard funds would make a globally diversified portfolio. So even in a globally diversified portfolio year to date, you would have been down. We've seen a similar result with a variety of different asset classes, as well. So we've established, right, we've entered this bear market, but where does this put us in the grand scheme of things? And Andrew, I thought it'd be great if you can talk about this next slide, really give us some insight in what, we've entered a bear market, but we've done this time and time again. So what does this really mean?
Market drops are temporary. And then they always are, they always have been. And so, as you see on the slide that Akshay is presenting here, you can see all sorts of different market declines. You've got the Great Depression there, the bankers panic in 1907. Obviously, the Great Depression was a crash of 29, 37, 38 recession. You have all of these different time periods where markets have dropped fairly significantly, but they're always short term. The markets always recover. So if you have a job, these are always wonderful buying opportunities. And I'm not saying you should hold on to cash and wait for an actual decline. Okay, so you might be listening to me and saying, well, Andrew just said that markets decline 1 out of every 3 years. True, on average. However, you don't want to wait with a bunch of cash for a market decline to actually invest your money. Add money as you have it, whenever you have it. And when a market decline comes, just be really thankful that it came while you are in an opportunity to continue to add money to the markets, whether that's on a monthly basis or whether that's a lump sum that you get through some sort of commission. Because what you're buying today, you're buying at a discount. You're buying the same things you might have been buying last year if you're adding money monthly, or the same things you were buying the year before, but you're getting them at a much cheaper discount. And as I mentioned, when we started off with this, when I actually first brought this chart up or this table up, it's the idea that all of this stuff is temporary and these discounts don't last forever. Eventually the markets end up rising, and assets that you have put into the market at lower than average rates. And that's wonderful because we get a lower than average rate if you're adding money in 2022. Eventually that money will end up recovering and your money will rise along with that recovery.
Perfect. And look at exactly what you've just said, Andrew. And as a smart investor, you shouldn't only expect bull runs. There's always going to be the eventuality of bear markets. And with that with that consideration, it's really about how to take advantage of these markets. And we're going to be talking about that a little bit more towards the end of the presentation too.
Yeah, it is interesting, isn't it, actually? Because taking advantage is just keeping a cool head and staying on track and keep adding money. So if you keep adding money every month, you are taking advantage of the discounts.
Yeah, exactly. And yeah, another thing, huge topic of this year, we've been hearing about it pretty much since, I'd say, since mid 2021 also, it's been inflation. We started the year with, post-COVID global economic recovery. This gathered a lot of momentum. But then since then, inflation's been on the rise. Andrew, I wanted to hear sort of your insight on inflation, what this means for an investor also.
Well, it's interesting when many people are and fear inflation. They think, oh, from an investment perspective, this has to be bad for something like the stock market. But then we're really forgetting what the stock market is and how inflation is actually measured. So take this pencil, for example. So the price of this pencil will have risen. Let's say it rose 7% this year. Okay, now if the manufacturer of this pencil is 3M, it's a company that trades on the stock market. What happens to 3M's gross annual profits? Well, if volume is exactly the same, and say it sells the same amount of pencils, and they raise the price of pencils 7%, well, that's basically how inflation is measured. It's the price of the goods over time that are rising, and it's the companies that are rising those prices. And so the companies are on the stock market. You can see how this is all connected now. And I think too, actually, you have a pretty cool chart showing indicators of high inflation levels and then how stock markets perform during those periods. And this is why we have this really strong long-term connection with rising prices, rising profits for businesses long-term.
Yeah, exactly. And I, even these charts that we've got up here, I really wanted to just focus on the chart on the right. It looks at inflation rates from 1970 to today, 2022. And the reason why we've backdated it to 1970, the 1970s in general, is because this period of time, was one of the highest inflationary periods that we've ever experienced. Inflation rates hovered around 14%. That's why it's actually important whenever you look at any economic data, it's key to always point, to look back at stuff. Always, it always seems like doom and gloom when you're in it at that point in time. But if you zoom out and you truly see how economic cycles work, it's always not as bad as you think it is. And one of the best ways to counteract inflation is to be invested. It's actually one of the only ways to really counteract it. So yeah, I just wanted to obviously drive that point home as much as possible. So as inflation, has continued to be a global issue this year. So what do we do about it? One of the main reasons for inflation is consumer and business spending. We saw this as a result of economic stimuluses. Consumers have been spending a lot, and one of the ways to actually cool down inflation is by reducing overall spending. And a key way that central banks actually do this is by implementing contractionary monetary policy. And this is something such as an interest rate hike. By actually raising interest rates, this makes credit more expensive. This reduces consumer and business spending, and ultimately this results in lower economic growth and lower inflation. We've seen this year interest rate hikes constantly, with the first three of around 0.7%. Most recent one just, a few days ago, the hike was 0.5%. And the problem that we face this year, I wouldn't necessarily even call it a problem, but one of the realities that we're facing this year is that, the cost of living has increased, but consumers continue to spend. And that's one of the big reasons why the Feds continue to raise rates. The chart on the right, it highlights the performance of the US stock market in particular throughout the past hike cycles. And there's two very important things worth noting. Number one, rate cycles are part and parcel of investing. And although the economy follows a long-term positive trend, periods of economic downtrends happen every now and then, right? But secondly, something that's very key is, the stock market has a robust record during these times. Constantly posts positive annualized returns in 11 of the past 12 rate hike cycles. And this has resulted from various macroeconomic events, wars, financial crisis, even a pandemic. And that's one of the key reasons why, regardless of what's going on in the markets, I guess regardless of what's going on in the economy, the stock market also can always kind of react a little bit contradictory to that. And that's why it's so unpredictable in itself.
It's kind of interesting, Akshay. I know in my books, Balance and Millionaire Expat, I actually also showed unemployment figures. When unemployment figures were 6 months away from a historical peak. And if you watch CNBC, they would probably say something like unemployment is really high. Of course, we're not dealing with that right now, unemployment, but it is interesting how you think this is an economic sign. Yes, it is. when we're looking at unemployment rates, and you think that somehow it's going to be affecting the stock market. And what's fascinating when we look historically is when unemployment rates are high, when they're hitting a peak, historically, the next 12 years for the S&P 500 has actually been a fabulous return. So it's kind of the opposite of what people would expect. And it's not because, high unemployment equals high future stock market returns. It's the fact that, these things aren't as connected, as you mentioned, Akshay, as many people think on a short-term basis. And so the economy is not the stock market, and the stock market is not the economy.
Yeah, it's an extremely key point. And I think that's so important for people to just understand. Obviously, it's easier, to, I guess, talk about it. And it's always challenging to see your portfolios down. But that is just a reality of life, unfortunately. But I wanted to go into kind of a different direction now. We've been talking about inflation. We've been talking about interest rate hikes. Another very key theme of this year was international conflict. There was developments of the Ukraine-Russia crisis. This is one of the largest military escalations that we've seen in the past few years. And, events such as these are known to occur every now and then. And they've had always tend to have an implication on global markets, but more specifically on the short term. And like, I don't want to get too granular on the subject itself because it's something that's constantly evolving, but we do know that the conflict has had, decreased supply chains. There's been higher cost of food and crops, and a variety of different economic sanctions. All of these factors have contributed towards inflation to some way or another, and in turn, that's impacted markets and also our portfolios. And one of the key commodities that actually has been impacted is oil. Russia is one of the leading producers and exporters of oil and gas. The Russian war in Ukraine has drastically interrupted oil supply. This includes sanctions against Russia, and oil prices and oil company stocks have been one of the few assets in the green this year. And I think that's why, you see these companies in a globally diversified portfolio and you almost thank yourself that they're in there. Whilst the outlook remains always relatively uncertain, it's important that diversification, is always a key factor. And then just going back into, I guess the topic of international conflict, one thing is key. One thing is always known about international conflict is that every time that there's been one of these sort of events, the result has been completely different every single time. We look back at 9/11, we look back at, right now, we look back at the world wars, and it's always been a very different thing. And like, that's the only certainty that we know, is that it's always going to be different each and every time. Okay. And, really, we've been addressing some key themes of the year. Inflation, interest rate hikes, geopolitical tensions, all of these have been main topics of the year. And all of these factors have led to market volatility. These are fluctuations. If you don't know what that is, market volatility is just ultimately fluctuations to be expected when you invest in the market, right? Regardless of the asset class, the geography, the sector that you're invested in. There's always going to be a level of volatility associated with this. And this means the value of your investments, they're going to go up, they're going to go down from time to time. It's something that is part and parcel of investing, and markets tend to perform in a very rational manner. And I just wanted to illustrate this chart, right? It's a chart that displays the S&P 500 PE ratio, right? From 2012 to 2022. And, if anyone's asking or thinking, all a PE ratio is, it measures really how highly investors value a company. And right now, we can see from this chart, investor sentiment is quite low. Investors are not necessarily valuing companies as high as they have in the past. This ratio by itself isn't enough to paint the full picture. And there's always a lot of other factors that to consider when investing in anything. But while looking at these figures, it's important to understand that economies, aren't stock markets. Exactly what Andrew was saying. Macroeconomic forecasts have a tendency to be either wrong or completely unrelated to equity market performance. And that's why, regardless of market volatility, regardless of what's going on in the economy, it's really important to try to stay invested, right? So, with all of these kind of key themes we've been discussing, right? We've talked about inflation and interest rate hikes and geopolitical tension and what this has meant for volatility. And, these are key themes of the year, but I really wanted to spend a lot more time just really delving into what this means for the future. What does this mean for maybe 2023? What does this mean even beyond that? And that's why I wanted to pass over, the next section over to Andrew to really discuss, some investing lessons for 2023.
Well, the most important thing, I think, is Yeah, controlling what we can control. I mean, and this is a really good slide. We can control how much we're actually saving, and we can control our behavior, and we can control our investment costs, and that's it. We can control our level of risk, and to an extent, we can control our time duration. So I did end up talking about these things in a really backwards manner there, Akshay, but ultimately, those are the things that we can control, and we can't control the markets. And so with 2023, this is what I actually hope. And this might sound controversial, especially if you are new to investing. I hope the markets fall a little further and stay down for the entire year, calendar year 2023. That's a little bit selfish on my part. I say that because I'm someone who adds money to the markets. Anyone who is adding money to the markets should think exactly the same way. Exactly the same way. If you don't know how this works. If you're retired, I understand you probably want to throw eggs at me right now. I get that. As a retiree, you're in a decumulating phase. You're actually selling off pieces of your portfolio. So market drops for you aren't necessarily things for you to be celebrating. However, if you are a retiree, I do want to say this. Again, keep your calm, because when we look at back-tested studies on something like a 4% inflation-adjusted withdrawal rate, historically, if you have a diversified low-cost portfolio, it really shouldn't matter what the markets do. If you are withdrawing that inflation-adjusted 4%, your money should last at least a 30-year duration. If you get really, really worried and start reading some articles that say 4% rule doesn't work anymore, okay, if that bothers you, of course, no one knows if it doesn't work anymore, because you'd have to be able to see the next 30 years for that to actually occur. But if that kind of thing bothers you, then when you are withdrawing money, don't give yourself an inflation-adjusted raise during years when markets drop. So it really is that simple. But back to those who are accumulating assets, stay the course, continue adding money whenever you have it. If you get a big commission, don't start thinking about, oh, is it the right time to put it in the markets? Put it in as soon as you have it. If you're investing on a monthly basis, fabulous, keep adding money. And if 2023 doesn't end up with a market recovery, be really thankful, because you're going to be accumulating assets on the low, and ultimately that is going to accentuate your wealth later down the road.
Perfect. And Andrew, you just talked about, praying and hoping for, the market to continue to go down in 2023. And there's this, there's an article that you wrote a few months ago about monsoon rain. And I remember, I feel like this sort of story and this article really captures that really well. So I'd love if you could share, a little bit about that with the audience.
You might have to remind me, because I sure write a lot of articles.
Oh yeah.
Akshay.
Okay. So this was all about, really, it was all about, basically when, a lot of people are, I guess, greedy at times when they're not supposed to be. And, there's the village in India, and ultimately they wanted a bunch of rain to kind of occur. I'm not sure if that's ringing a bell at all.
It had to do with speculation, didn't it?
Yeah,
it had to do with somebody like pulling out of the markets.
Yeah.
And just deciding that they're gonna hide in some cave, and they're gonna pull all of their money out of the markets. And that cave is far from the village. And meanwhile, the people in the village, the monsoon rains come and the people get wet, but they're there, and they're prepped and ready for when the rains dry up. They're prepped and ready to grow their crops, to get things all sorted out. Meanwhile, that guy in the cave, he's still there, and he's hiding because he doesn't want to get wet. And he figures this is the best way to do it. And then when the rains stop, I'm going to come out of the cave. So the rains stop, he rushes out of the cave, but then he rushes back in because it starts pouring again. And he keeps getting suckered by this. It's like, I'm ready to go back to the village, and the rains come, and he goes back into the cave, back and forth, back and forth. And then eventually the rains really do stop, but he sticks around in the cave. Meanwhile, the friends in the village who stayed in the village, they've got wonderful crops going on. By the time this guy gets out of the cave and he comes to the village, he can't grow anything. So, to Akshay's point, thanks for reminding me of that, Akshay. But that's the market. It's somebody who pulls out of their market. Like, I'm going to protect my assets. I'm pulling out of the market. I'm going to go back in when it's better. And so, they put a little bit of money in when they see the markets rise a little bit, then the markets drop, and then they pull it back out. Then they continue this crazy process, which really ends up ultimately and consequently buying high, selling low over and over and over again, and or just missing out on the next big rally because the person has their money stuffed in a cave with them.
Exactly. And it's funny that you say this, because this actually happened this year. We have so many investors that during 2021, the market was going up, and they were investing constantly, very religiously. Every single month, they're doing exactly what they're supposed to be doing, putting money in. And then all of a sudden, January, February hits, the market starts to take a dive. They're like, oh, the market is doing badly. I should stop now. And what happens is with that is we've got to the end of the year now.
I shouldn't laugh.
Yeah.
Sorry, everybody. I shouldn't laugh. A bad boy. Bad boy.
So we've got to the end of the year now. And if you look at a client's portfolio where they had basically done this strategy, right? They're investing all of 2021, buying assets at the the highest price possible. Then when assets start to decline, when the market starts to decline, they've stopped completely. And then they look at their portfolio year to date, and obviously they're down the same as the charts that we saw before. But then you've got the other clients, other investors on the other hand, where regardless of how the market's been happening, whatever's been going on, religiously every single month putting money in, and they have taken advantage of that opportunity, right? In October, market started to basically perform a little bit better. Their portfolios are doing a lot better as a result of it. And I know, I think it's a big psychological thing, right, Andrew? It's like the market's going down, so I shouldn't invest. We want to think about it. Your bananas example is exactly how we want to think about it. These assets are cheaper than they've ever been. You want to be buying them on a discount.
Yeah, it's kind of interesting because we've had that year, Akshay, where the markets have, they dropped from the beginning of the year right down to about June, and then they rose again, and then they dropped again, and they rose again, now they dropped again. And so for someone who just puts their hands over their eyes and just buys every single month with, say, the same amount of money, they're buying fewer units when the market's rising with that money, and they're buying a greater number of market units when the market has dropped. So over the course of the last 12 months, they've paid a lower than average price. So if you looked at what the average level of the market was over the last 12 months, they've paid less than the average as a result of just dollar cost averaging and just closing their eyes.
Exactly. And then the most important thing about that is when the market starts to rally back up again, the investor who stopped investing about a year ago, by the time they get their portfolio back to where it was before, it's going to take a while. But this person who's been investing every single month, regardless of the market, it's going to happen a lot faster. And that's just the key about it, right? It's just being disciplined, being just focused on that, I guess, ultimate goal, and that's very, very key. So, we've talked about what we can control and then what we can't control, right? The return. It's something that we mostly focus on. But let's say even if we focus on the return, right? This is what the global markets have done, right? The beauty of global markets are over the long term, markets generally trend upwards. All of these volatile moments, it's something inherent to investing. But if you're patient enough, if you're disciplined enough, you will be rewarded. This chart, I love it. It represents if you'd invested $1,000 in 1925. And before anyone says I wasn't alive in 1925 or whatever that is, obviously purely just for illustrative purposes. But it really paints a picture, right? If you'd invested this $1,000 in a variety of different assets, right, since 1925, you would have gone through the Great Depression, World War II, the Korean War, the dot-com bubble, 2008 financial crisis, COVID. All of these are very notable events. And in history, you'll notice the chart, even with its ups and downs, it trends in a very particular direction. That direction is upwards. Had you invested that $1,000 in 1925 and you invested in, globally diversified portfolio, you will have achieved over $5.3 million. The important thing is to look at markets in their entirety. Take a moment, zoom out. You will see that markets always rebound. They always trend upwards. And that time is actually your biggest ally. And that's why it's really important to think long-term when you are investing.
Yeah, we talked about 30-year durations being really the only durations that matter, but it's so hard emotionally for people to not worry when they see their when they see their portfolios drop in a given year, and to place overemphasis on how the markets have performed in 1 year or 2 year or 3 year period, and then obviously making up stories about the economy and things are only going to get worse. But we know that the worst 30-year period in history was from 1929 to 1959. So 1929 was right at the cusp of the Great Depression. So we had obviously the biggest crash in market history. It was an 87% decline from 1929 to 1932. And yet over that 30-year duration, the markets averaged 8.24%. So that would have turned a $10,000 investment on January 1929, which would have been the worst time ever to lump a $10,000 investment in, would have turned it into $107,000 30 years later. So for those of you too who say, well, I don't have 30 years. If you're 60 years old, you have 30 years. Your investment duration is your lifetime. So obviously there's an accumulation phase when you're actually investing money, when you're working, and there's decumulation phase when you're selling bits of your portfolio. But ultimately your investment duration is your lifetime. So if you're 30 years old, your investment duration is 60 years. I mean, hopefully if you live to the age of 90. And so when I say something like the only term that matters, the only duration that matters is a 30-year duration. And then as Akshay points out, the trend is upward on all of these 30-year durations. And then of course, looking at the very worst 30-year duration, even that was a spectacular return. So yeah, we have to think long-term. We have to try and rewire our brains to not place an emphasis on what's happening today, tomorrow, even on a 5, even a 10-year period.
Yeah, exactly. And really just, before we go into the Q&A, I just wanted to summarize some really important takeaways, for the year that we're coming up to, but also regardless if it's this year, if it's next year, it's the year after, these are investment lessons and takeaways that you want to basically use for the rest of your life. So market crashes are always going to happen. That is part and parcel about stock market cycles. And it's something that you just need to understand and be comfortable with. Treat it as an opportunity. Instead of exiting the market during these market crashes, good investors should always seek to take advantage of stock market crashes, right? Going back to Andrew's example about the bananas, right? You want to buy these assets on a discount. If it's this exact same assets, you're going to be averaging out your price per share. You're going to be lowering your price per share so that when the market comes back up, you're going to be in a much better position than that person who just stopped investing. A really good way to do this is through dollar cost averaging and just general long-term investing. We've just talked about it. Really think about this in 30-year cycles. The worst case scenario, as Andrew mentioned, is still a pretty good case scenario in that 30 years. And this, this last point, I would say, is the most important thing. It's that spending time in the market is the most beneficial thing, as opposed to timing the market. The market rises more than it falls. And with that being said, I think we've come to the conclusion of our presentation. So thank you, everyone, for submitting all of these excellent questions. I'm just going to go through them now, and we can get started. Okay, just give me a quick second. Okay, got a question over here. So I realize that we cannot time the bottom, but economic and financial indicators are here and inform us of what's going to happen. Seeing as we're headed towards a harsh recession in 2023, why not pause dollar cost averaging now and just get in once the crash happens? We're still at 20% down. And during the most hard market downturns, the stock market goes down by 50%. Why not wait until then?
Intuitively, that makes sense. But we have to be able to see the future to be able to do that. And there are reams of people who have tried to do something like that. So analysts that work full-time for hedge funds, for example, will do something like that, often pulling all of their money out, putting it into cash, sometimes even shorting the market, trying to figure out when they can put money back in at a market bottom. But nobody knows when that market bottom will ever be. The market bottom may have already occurred. The market bottom may be another 10% or 15% drop from the current level. Nobody knows. So it's a lot like, that example when I gave about the monsoon and the guy that runs for the cave, trying to look for the opportunity to grow his crops at a better time and not get wet. When we look at peer-reviewed economic data, peer-reviewed economic data suggests that nobody with any degree of consistency can time the market. Warren Buffett is the greatest investor of all time. He has never at any point decided he was going to sell all of his investments because he believed that the markets were going to drop and he could take advantage of that drop and then pour his money back in. If he believed he could see the future, or if indeed he could see the future, Warren Buffett would try that. But he knows, and he says over and over, there's no shortage of economic forecasters trying to tell you what's going to happen in the future. But he says economic forecasters, or stock market forecasters in particular, exist, and these are his words, to make fortune tellers look good. So my advice is to stay in the markets and continue to add money. You will beat the vast majority of people who try to technically speculate. So not my opinion, it's peer-reviewed economic science that reveals that as a reality.
Perfect. Thanks for that, Andrew. We've got another question here. So we've got somebody asking, so for someone conservative in their mid-20s who starts investing now, what advice would you give at this stage in terms of what to invest in?
So I would suggest a fully globally diversified portfolio of ETFs. I wouldn't alter my portfolio allocation based on how the markets are performing or any kind of forecast. So if you are in your mid-20s and you're relatively conservative, you could put together a portfolio, let's say 60% global stocks and 40% global bonds. Some people may listen to that and say, wait, that's really conservative for somebody in their 20s. And yes, they could consider that. But what's really important is that that person in their 20s is able to emotionally and behaviorally stay the course. And if that's required for them to stay on track, then that's going to be the best portfolio for them. So somebody else might say, well, the growth prospects of a 100% global stock market ETF without any bond allocation should have a higher long-term performance than something 60% stocks, 40% bonds. While that's true, technically, on a behavioral level for that actual investor, that might not be true if it has enough volatility such that it freaks them out and has them pull out of their investments, perhaps when they shouldn't be pulling out. So yeah, I think if you're a conservative investor, 60% global ETFs, 40% global bond ETFs would be great. Just keep adding money.
Perfect. Thanks for that, Andrew. I've got another question here from Mohammed. I'll be happy to take this one. It's a bit Sarwa related. So Mohammed's asked, I have a Sarwa account. Is it beneficial for me on the current situation to add more money for dollar cost averaging? So yeah, actually, I mean, I guess it's phrased in a Sarwa way, but honestly, this applies regardless, Mohammed. Just in your investments in general. If you're in a globally diversified portfolio, which obviously you are in with Sarwa, it's an absolutely fantastic time to invest money. One of the main reasons as to why is what we talked about first, right? The market is down at the moment. These are good quality assets at the end of the day. We have seen how they performed over a long period of time. So it's a really good idea to continue to invest in them. But then I'd also go, even further than that. Mohammed, regardless of if the market's going up or if it's down, regardless, it's always a good strategy to have that dollar cost averaging. Because in reality, we don't know, when the market's going to be up or down or anything like that. But what you do know is, what you can control is the amount that you can invest and the frequency that you can invest. And if you can do that regardless of the market, you're going to be in a really good position. Try to do that for a long period of time, 10, 20, 30 years, you will be in a really, really good position. Okay, let's take a look. Got quite a few more questions over here. Let's see. Got another question. So somebody's asked, can we really say we are buying ETFs on the low? What if they were already overvalued, due to COVID stimulus and investors buying in general, and even current prices, 20% down, are those still overvalued?
The idea here is try not to think about whether something is overvalued or undervalued. When we look at actually who performs best, typically with investment brokerage portfolios, they're the people that don't think too much. They're the people that don't tinker. They're the people that are on autopilot. And so it's best not to think about whether the markets are undervalued or overvalued, or which sectors might be undervalued or overvalued, or which country might be undervalued or overvalued. Just add money on a monthly basis, month in, month out, year after year, whenever you have your money, and you will outperform about 90% of investment professionals. And many of those investment professionals are the hedge fund managers, college endowment fund managers, institutional managers that are trying to speculate and trying to figure out whether they think something is undervalued or overvalued. So it's an easy way to beat the vast majority of them just by staying the course.
Perfect. Thanks for that, Andrew. I've got a question over here from Rakesh, and Rakesh has asked, what is your thought process in investing in just the S&P 500 as the companies, as it encompasses a true, or does it encompass a truly global? So I'm happy to take that, and then obviously, Andrew, please feel free to add on. So Rakesh, in terms of investing, in just the S&P 500, at the end of the day, I know we use the S&P 500 as a benchmark, and a lot of people compare their investments to that. But the S&P 500 is actually just the 500 largest companies, specifically in the US. So number one, those are just high capitalization companies. So it's very specific in terms of the type of company, but also it's very specific in regards to the asset class because it's stocks only. And it's also very specific to the geography, right? It's just the 500 largest companies in the US. I think a lot of people forget a period of time called the Forgotten Decade, right? Where the S&P 500, I believe it was from the year 2000 to 2010, where the S&P 500, didn't actually have that much growth at all. And if you were just in the S&P 500 or just in US large cap companies, you wouldn't have basically reaped the reward of being in a globally diversified portfolio, right? When you're just invested in the S&P 500, your risk is much more concentrated. You want to be invested in markets and assets that negatively correlate and are really designed to produce a globally diversified portfolio. So exposure to emerging markets, to foreign developed markets, to US markets, but then also going a little bit further, right? If you have, if you need to have a little bit of element of, a conservative portfolio, you want to have some fixed income in there, corporate bonds, government bonds from a global scale. So that's why it's really important, I'd say, to really have a global portfolio, you need to invest globally as opposed to just the US.
Yeah, that's an awesome answer. Actually, there are people that, one argument that the listener might have, the questioner might have thought about or might have read is that you take a company that's in the S&P 500 like Coca-Cola. And so 70% of Coca-Cola's actual sales are outside of the United States. So there are people who will say, oh, well, if that's the case, and many of the S&P 500 or all of the S&P 500 companies actually also sell products globally, then just by investing in the S&P 500, we have full global exposure. There's an argument to suggest that, however, to Akshay's point, which is really, really important, it's that different stock markets are valued in different ways at different times. And so when we looked at the US market from 2000 to 2010, there was no gain. I mean, markets went up, then they went down, they went up, and then they went down, but there was like no net gain. So you basically had, including dividends, you had a 10-year period known as the lost decade. During that time period, however, you could have had, emerging markets just absolutely soared from 2000 to 2007. And so if that were part of your diversified portfolio, well, there's an added plus there. Developed international markets actually ended up outperforming the US stock market during much of that time period as well. And so there's an added bonus as well. But to that main point is that we really do reduce risk by having full global diversification. So we reduce risk and we reduce volatility. And we always ensure that if there's a party going on somewhere, whether that's an emerging market party or it's a developed international party, or whether it's a US party, we're part of that party. Our investment portfolio has exposure to that party. And that's what we want.
I like that, Andrew. I think I'm going to start stealing that and start using that. The emerging market party and the US party. And actually, funnily enough, in the tune of us talking about the lost decade, Robert's asked a really interesting question. So there's a global debt crisis. The Fed seems to be kicking the can down the road. And at some point, the Fed will pivot, restart printing, and stimulus money will come in again, and inflation will go up again. So what's the end game here? Are we really in a lost decade similar to the one between 2000 and 2009?
No one's ever going to know, but I'll tell you what, if you have money and you're investing in the stock market, this is probably one of the best things that could happen to you. So especially if you're fairly early in the stock market game and you get a lost decade, oh my gosh, it's amazing. I mean, I've used the example of the catapult where, you are literally pushing assets onto a catapult that is held down. And eventually that catapult is going to end up rising. Markets always go too far in either direction because it's based on human sentiment short term. It's not based on economics, it's based on human sentiment. And so it's based on fear and it's based on greed. And so that's why no one can ever predict the stock market based on, you can have all the economic data in the world. In fact, you can have all the economic data in the world in the future. You could have a crystal ball that tells you all the economic data in the world over the next 10 years. Not going to help you determine how the stock market will perform, because the stock market is about human emotions on a relatively short-term basis, not necessarily the economy. So a lot of people try and make those connections between the two, but it's really loose and really dangerous to try to do so. So back to that point, just keep adding money. Don't think about and don't worry about these technical things. Fill your brain with other things. Learn another language, learn yoga, learn things that will actually end up helping and enhancing you and your life going forward, because thinking and worrying about the economy won't do it.
Great. Thank you for that, Andrew. I've got a couple of questions here that are kind of similar, so I'm going to just address one of them. So we've got somebody asking, I've invested in US pharma, which is terribly down at the moment. I'm at this stage where I don't want to exit with steep losses, but not sure what's the best way forward. Okay. So I guess, yeah, with anyone investing or trading as per se in one specific asset class or one specific company, there always is going to be a much higher level of risk, much higher level of concentrated risk. With that, one of the easiest ways to I guess, get out of that or to really allow yourself to prosper in the future is being invested in a globally diversified portfolio. It's something that we've talked about a lot today. In terms of, I guess, in terms of your next steps and what to kind of do with that, it's a little bit difficult to I guess, to comment without knowing more specific circumstances. What is that time frame for you? Do you need that money overnight? Do you need it, within the next couple of days, within the next couple of weeks? But if you don't necessarily, it could mean that you could maybe wait it out a little bit longer. Another option is to potentially cut your losses and then invest in a globally diversified portfolio. But to be completely honest, it'd be difficult to, to ultimately, provide a recommendation on that without, knowing a little bit more. So please feel free to reach out to us, via email, and we're more than happy to kind of have a conversation to discuss a bit further. Okay, got a question over here. So how bonds and stocks do not have inverse correlation now? And what should the investors do?
The investors should just stay the course. When you look at bonds, there isn't always, and there has never always been, an inverse correlation. So that's a bit of a myth. But bonds have dropped more significantly than they have in the past. But there have been several times when the stock market has dropped and bond markets have dropped. Not as much as what we've seen recently. And the reason they fell so much recently is because inflation and interest rates rose considerably. And when that ended up happening, so many individual bond owners were saying, well, I've got a bond and it's paying me, let's say 1% per year, an individual bond, but inflation is 6%. So I'm going to sell this. So based on supply and demand, the prices of bonds ended up dropping. In my book, Millionaire Expat and Balance, and The Millionaire Teacher as well, I talked about having broad or short-term bond market index in case something like this happened. And so when you have a short-term bond market index, the bonds within that get replaced fairly quickly. And so when interest rates rise, newly issued bonds end up with a higher interest rate attributed to them. So yeah, the bond market indexes are going to recover. So I know that with Sarwa, their bond market indexes are broad, which means they're not focused just on long-term bonds. So long-term bonds are the dangerous ones because you're kind of saddled with a specific interest rate over a long time period, which is a horrible thing. Whereas a broad or a short-term bond market index, the entities within them are getting replaced, and they're getting replaced at higher interest rates. And so what's going to end up happening is there is going to end up being a recovery. So instead of worrying about whether, why are they not inversely proportional? Why are bonds not rising as stocks fall? Well, that's the answer as to why they're not rising, but don't worry about it. I think that's the most important part. Just continue to add money. And actually, it's a real blessing that the bond markets are down as well, because when you're adding money, you're getting a discount on those as well. Because as those newly issued bonds are paying high interest rates, the market, the average person, hasn't really caught on to this yet. They're just freaked out the fact that this entity is low, that their bond ETF is low. So this year I've really enjoyed adding money to the markets, or my overall portfolio, really enjoyed it, because not only am I getting a discount on my stock market investments, I'm getting an investment discount on the bond ETFs as well.
Great, thank you for that, Andrew. Saad's asked a question over here. So how about creating a portfolio with a growth ETF and a small portion in an inverse ETF? So Saad, thank you for the question. I think with that, we're going to go back to diversification, right? It's all about trying to invest in ultimately a portfolio that has a variety of different asset classes, a variety of different sectors, a variety of different geographies. You want to have growth companies in there. You want to have value companies in there. As Andrew mentioned before, you want to be at every single party right at the end of the day. If you're interested in investing in growth ETFs for the purpose of more returns, I wouldn't recommend just sticking to growth companies, but I would recommend to have a higher allocation towards equities as opposed to fixed income. Equities are really what I would say provide growth in the long run. They tend to be more volatile in the short term, but over extended periods of time, the equity market, as we looked at in a couple of slides before, has performed extremely well. But you also do want to have some fixed income in there. The closer you get to retirement, the closer you get to that goal that you're trying to achieve, you want to have a proportion of fixed income. And the reason for that is, look, during volatile times, that acts as a cushion. That's a much more stable and secure investment. But really, it's important to have that globally diversified portfolio. Have everything in there, because that tends to perform extremely well. What happens if, for example, the growth ETFs that you're in, all the growth companies are performing poorly? You don't have, your eggs in multiple different baskets to ultimately diversify your risk further. And not only does it come at a risk mitigation tool, but diversification also is an enhancer of growth, right? So think about it like that, Saad. But thank you very much for the question.
Actually, I wonder too, when the questioner asked about an inverse ETF, they may be talking about an ETF that actually gains in value when the markets drop. Did they actually use that word, inverse ETF?
Yeah, exactly.
Yeah, so in essence, what they're trying to do is basically, it's like shorting the market. So when an ETF actually, when the market ends up dropping with an inverse ETF, in theory, you can end up making money when the markets drop. So the problem with that, or the risk of that, is that nobody can consistently do that very well and actually end up making money. So, by owning those two, I think you end up, especially with the inverse ETF, the inverse ETF ends up significantly adding a level of risk, because markets tend to rise far more often than they fall. So if you have an inverse ETF as part of your investment portfolio, you're basically doubling down on risk. So because we know markets rise more often than they fall, an inverse ETF in itself is going to fall more often than it's going to rise. So that's a level of risk that you really don't want to have.
Perfect, Andrew. Thank you for that. Got a question over here, a little Sarwa related also. So how does Sarwa work for expats that might leave the UAE, and will they still be able to access it? Looking at a timeline of 10 to 20 years. Really good question, So in terms of Sarwa, look, we, at the end of the day, we are a global platform. So it's not exclusively for UAE residents whatsoever. We operate in an offshore economic free zone in the DIFC as well as in ADGM. So that allows us to ultimately advise clients and onboard clients globally. We use Saxo Bank as a brokerage, Citibank as a custodian. So you can actually fund your account as well as withdraw your account to any bank account in the world, regardless of whether you're in the UAE or not. So hopefully that answers that question. You also mentioned you're looking at a timeline of 10 to 20 years, and look, that's completely fine. A lot of the times, if you are moving to, let's say, a highly taxed jurisdiction, and that's your home country, that's when it's worth having a conversation with us because we can advise you on the best next step. Right? It doesn't always make sense to keep a SARA account in, let's say, the UK. There's much more tax favorable solutions such as a general investment account, and you can contribute towards your ISAs, for example. So what I would recommend is, if you do get to close to that time to leaving the UAE, reach out to us and we can have a conversation. Perfect. I've got a couple more questions here. So Andrew, I'm going to ask you this one. So we had a question asked, we're in our 50s and just started to invest last year. I know we're late. We put all of our capital into VWRA and IGLA. Both of them dropped around 20% so far. Please, do you have any advice if we want to retire in 10 years? So we stick to investing in the same for the next 10 years. What if they don't recover?
So there's never been a point in history where somebody started to invest and they invest on a monthly basis. And at the end of a 10-year period, by dollar cost averaging, they didn't actually have a profit. So we went back to that last decade. And I said, one of the worst markets to invest in was the S&P 500. Akshay brought that up first from 2000 to 2010. That was the last decade. And so if somebody had started to invest, let's say they were in their 50s and the early 50s, and they started just with the S&P 500. So we're going to make this really bad, so we're going to give them a lost decade. They started to invest in their early 50s and they invested for that 10 years monthly into the S&P 500. They would have actually ended up earning a return of about 6% compounding per year at a time period when the markets went nowhere. Why? Through the process of dollar cost averaging, they bought fewer units when it rose and a greater number of units when the markets dropped, because that market during that 10 years, it didn't just go flat for 10 years, it did this. And that's typically what will happen even if you do get a lost decade. It'll do what this year has done. It's kind of been an up and a down and up and a down. And so as a result of that, you would, even if you got a period of 10 years where the markets globally, like hopefully you're going to have a globally diversified portfolio, something fully responsible, not just an S&P 500 ETF. And you do have that because you mentioned you have VWRA and then you have IGIL, which is the global bond market index. And so over a 10-year period, we've never had a period in history where adding money to the markets and diversified investment portfolio hasn't over a 10-year period ended up with a profit in the end. So you should be fine.
Andrew, thank you very much for that. So we're actually coming up very close to 7 o'clock. So if it's okay with you, Andrew, maybe we'll do a couple more questions and then probably wrap it up. I don't want to keep everyone too late. And there's a lot of questions, people are asking, is this going to be, can you share the slides and can you share the presentation? Everyone who's registered this, don't worry, we're going to be sending out the YouTube link. So you can obviously watch this and share it with, your family members or friends or whoever it might be. So Nasi has asked a question. It's an interesting one. So Andrew, with your lifestyle, in addition to your income, you of course need to decide when you should sell some investments to earn some income to live your regular life. So what factors do you use to make the decision to sell? Although your investment timeline is your lifetime, you aren't keeping your money in investments forever, right?
Yeah, that's a really good question. I guess if it's asked of me on a personal level, although I still have income, so I'm still adding money to the markets just through, obviously book royalties and speaking royalties and writing my regular columns. So I'm still adding money to the markets. I haven't come to that point where I'm decumulating. But I think at that stage, like if I come to that point where the income that I'm generating through work is not enough to sustain my lifestyle, then naturally that would be a time period for me to start selling off some of my investment assets. It's not to say that I haven't sold any of my investment assets. So just on a super personal basis, my parents at one point needed help with a home purchase. And so my wife and I were able to sell a large chunk to help them with this home purchase. We bought them an RV as well, which was actually really, really cool. Just nice knowing that we had those sorts of resources to be able to help them with that. So yeah, I hope that answers that question. I think it really is a personal thing. Once your income is no longer able to sustain your lifestyle, then through retirement or through an income that starts to get reduced, then that's a point which you should start withdrawing from your investment portfolio.
Awesome, Andrew. Thank you very much for that. So I'm going to actually ask our last question of the evening. So we've got somebody who's asking, except for Millionaire Expat, which I read already, and Balance, which I'm reading now, what other books would you recommend for someone who starts now?
Well, there are plenty of books written by John Bogle, for example. Bill Schultheis has written several. Let's see, there's a neat little book called Quit Like a Millionaire. It's Christy Shen, I believe is her last name, and her husband Bryce Young. That's an interesting book. They're a young couple that retired early, just to fully embrace the FIRE movement. And that's kind of neat because it starts out with Christy, growing up in rural China, and she had no money at all. So that's a pretty cool book worth reading. I think too, once you get a really good sense though of how to do this, my recommendation is to stop reading finance books and start reading some other things that I think can enhance your life in different ways and fun ways. Because once you understand that you should own a fully globally diversified portfolio of ETFs, and then once you understand that when you are retired, you should be able to sell an inflation adjusted 4%. You could be a little bit conservative and creative with that too. So during down years, we could sell a little bit less if you choose to. During years when the markets have really, really risen a lot, you can sell a little bit more if you want. But once you understand those overall concepts, comes a point where reading more personal finance books probably doesn't augment your level of knowledge in a way that is actually going to affect your lifestyle going forward. So yeah, once you've read a handful of them, I suggest you start reading some other fun things, novels, and or maybe learning different things.
Thank you, Andrew. And look, I think you're a little bit modest and humble for sure, but I would say that, look, once you guys finish, reading those personal finance books, a great book to read is actually Balance. It goes, obviously it covers the personal finance elements, but it goes beyond that. It covers things, such as success for people, ultimately what you want to really achieve in the rest of your life. So I think beyond the personal finance, Balance would be a fantastic book to kind of continue with. Perfect. Okay. On that note, thank you everyone so much for your time today. We really appreciate all the great questions. If there's any that we didn't get to, I know there's quite a few. We're going to try our best to basically answer them directly by email, or just feel free to reach out to us directly, have a chat. Andrew, it's been an absolute pleasure. Thank you for your insights, the stories, all of the examples. I definitely know that our audience found that extremely valuable. So really appreciate you taking the time to speak with us today.
Oh, it was my pleasure, Akshay. Thank you so much.
Perfect. Everyone, happy holidays and take care.
I like that image. That's a good image.
All right.
Whose image was that one? Like the Buddha guy, the people doing their meditation.
I wish I knew. I think it's just all of our stock footage. But we have a proposal to start getting Sarwa staff to pose in all of these sort of things. So maybe it might be me next time. Maybe
yeah, you got to do you. That would be really good. So did you get a fair number of viewers?